three. Hey, everyone who's listening. I am here with a new member who has allowed us to go into uh, his own level of trading and where he's at. And we decided that, hey, when new members join, we send them the daily call template, right? Which is basically a weighted probability calculation scale where it looks at all these different principles that we add up. And then that will give you a trade plan to come in actually before the day starts. So you can come in anticipatory rather than reacting to the market. So we wanted to go through each category. Now, how we like to do this, right, is that for the next day, right, you want to do this before the new candle opens on the daily. Since we're doing this at 11:54 a.m., we're going to have to back test this. How you would want to practice this with yourself or your friend is, right, you have someone look away, right? If you're going to be the person doing the call, you would look away and then have your coach or me or whoever you're working with randomly pick a day where you wouldn't know, like for example here, right? And then you would just go through the principles on the daily call sheet to help you come up with a trade plan for the next day, right? So that's what we're going to do, right, today, right? I'm going to work with Matt here as if it is 10 minutes, for example, or even 15 or 20 minutes to 8 o'clock yesterday p.m., right before the new candle closes, so we have as much data. So we kind of have yesterday's daily close to look at right here. We're going to imagine that it's right here and not at where it's at now. And we're just going to go through that list. And just to get Matt involved here, I'm going to have him read off the template in that daily call list, which remember, everybody who joins, right, they get all the principles in that template. And if they have a toolkit or something else they want to add for more probability, they can add it to the list. But that template is fine in and of itself. Remember, I didn't add bigger picture patterns, multiple time frame analysis, and other things to it until I added the hybrid to it. So you can, this in and of itself is plenty. So the first category, Matt, is what now?
S and R, correct?
Okay, S and R, right? S stands for support, and R stands for resistance, right? Just as a basic, when price is coming down into a zone, which is two lines, right? That would be the support. When price is going up into and trying to break through something, that's the resistance, right? So they essentially act in the same capacity, right? They are areas where buyers and sellers will be active, right? Based on various key references that we look for and patterns within the chart. So the first category is support and resistance, right? And the choices that we have to pick from are up, sideways, sideways down, and down, right? So remember, when we are picking this factor in isolation, it's not what we think the day is going to do tomorrow. It's not what a sense of what we think it's going to do just by looking at it. It is literally that one category in isolation. So you could have one category in isolation that's bearish and all your other categories are bullish, and then you would go with a very bullish call. But you still have to honor the individual attribute of that call. So we are doing support, right? Support and resistance, right? Well, Matt, right? If we were looking at this giant pattern from February 26th of this year, coming all the way down into this year, what would we get, right? We would get a very giant trading range, right? Which is one of the basic patterns that we teach, right? A giant trading range is simply a phase of the market that is non-directional, where buyers and sellers are going back and forward. And you can tell after markets spend time just zooming out, in up markets, they tend to go sideways, especially when they hit double tops from previous years here. And all that was discussed in the red channel yesterday as well. So, but remember, we're just doing something in isolation here. So when price is approaching near the lower band of the trading range, we're at support, right? It's very basic. And when price is approaching, right, the upper band, right, in terms of this pattern, we are at resistance. Now, the lows and highs of a trading range are only one of the key reference areas that can form support resistance. And I didn't want to make this call about all the different things that we look for in terms of support and resistance because we could, overcomplicate everything. But just as an instance here, let's remove this. I wanted to get the VRV profile here because, remember, these highs and low range extremes are one of the ways we create support resistance. But I might as well just go into a little bit of this category of some of the ways that we create it. Remember, we would also look for horizontal support resistance, right? So if you don't have the VRV pinned on the right, you could just drag one like I just did and get this one that's kind of in the middle that most people from a larger time frame perspective are kind of ignoring. But you can see it's just an area that flips rolls here, especially here. Now, I will go back into all the ways that we create that, and I listed in the channel all the different key reference areas that form support resistance. But just to get back to the basic daily call template without going into too much detail about each category, because I just wanted to do an overall sense of the call, right? Would you say as price is coming down into this, more of the bulls are going to be in control here because it's support, or more of the bears are going to be in control, right? Well, if price was coming up here, right, like on these days, then the support and resistance category would be down to sideways down. Either one would be fine, right? Because that means that the bears are in control. And what do I mean by the differentiation between down and sideways down? It's to the degree of how bearish you are, right? Sideways down means you think it's going to go sideways for a little bit and then break down. So you would only fade a double top. We talk about execution. And down means, hey, this thing could just be a pure downtrend day or just break really quickly earlier in the day without a double top so I can get more aggressive and use a momentum-based setup, right? Which would be like a pullback continuation to the downside. But just going back to the categories of the daily call, we're not talking about execution, right? As prices coming up in there, we are at the lower bands of this range support where we launched out of this. And we know that when you have a big move, right, they come from big zones. So this is a very strong zone. So I would give, right, the edge, right, even though we haven't penetrated it super deeply, right, it's still going to be in the favor of the bulls. So for that support resistance category, I would write sideways to up because we are in that lower band. Does that make sense, Matt? And it's okay if it doesn't, because that's what this lesson's
No, it
about.
does make sense. Yeah,
Yeah.
this is I'm trying to comprehend
I
it.
mean,
Just
some of it can be that simple,
real
some of these
fast.
principles, like
Yeah,
in
yeah.
certain patterns. Okay, so the next, so that's what you would mark. So if I could flip this back, I could actually, I will do this. Let me stop the share real quick, and then I'll just to show everybody, and then
Of a chart.
I'll go to the Zoom here, and then I'll share this. So this is what Matt is looking at to fill that out. So for that category, right, sideways up is what we would write. Notice we did this. We should be doing this if this wasn't an exercise, right? But you should be doing this as an exercise a lot more than, oh, don't just start this and then start risking real money, right? So this is what we should have been doing. We're not doing this on July 9th. We're doing this on July 8th. Ideally, a little bit, no later than 10 minutes. You don't want to give yourself only 5 minutes, 10 minutes before the market opens. You could go, obviously, 30 minutes too as well. But that's the idea, this before it. So the next one we're going to look at is candlestick pattern. So let me just stop the share. And then from here on out, Matt will be just filling it out on his own, and you guys can just imagine it. So let me get that up again when I share this now. So Matt, right? The next category, just to remind everybody, is what? Candlestick pattern, right?
Correct.
Correct. Okay. So the candlestick pattern, right, is another isolated factor. Now, I'm not looking at these giant support and resistance zone where we have these confluence. I use that word in the channel. Confluence is just previous touch points where where sellers were active. And the more of them that line up in a zone, the greater the strength of it. So we had a touch point here, touch point kind of here, but we broke up, touch point here. So this is a good zone, right? But the candlestick pattern is saying, okay, we broke down here and it closed green, right? It's not like this thing closed down super red heavy, because if it closed super red heavy, even though there's a buying tail here, that's what this little wick is, I would mark that sideways down to even down because it closed heavy, right? Even if it closed a little lower. But because this had some liquidation and the buyers brought it up and it actually closed in the green, right? Slightly forming this little double bottom, and it kind of gave a little confirmation up. I would give the candlestick pattern also slightly, right, to the bulls, right? So I would write sideways to up for that category. Does that make sense, Matt? Or is that right? So
Yes,
imagine yesterday, like this is all the data we have, and we have this little green candle that's called a hammer candle visually because it kind of closed with some strength a little bit. But
yep,
you know, it's not super crazy bullish because the sellers did bring it back down. So it's not like, oh my God, but it also is happening in the context of this little 1, 2, 3, 4 day double bottom, right? Which is just retesting this. So, you know, but imagine that we didn't get that confirmation at the close while we were doing this call where this was green, but it actually closed very red without any tails, and it closed with a very red candle near the lows. Then the candlestick pattern would be, you know, for example, if it closed all of this and was lower, it would be called a bearish engulfing pattern because it engulfed all this. So it'd be down or even sideways down would be fine. But because it didn't do that, it's sideways up because it's a hammer candle back up into the double bottom pattern.
makes perfect sense.
Great, exactly. With the awesome. Okay, so we marked that one with an X sideways up, right? So I'm hoping you're going to keep track because I'll probably forget by the end of it because I'm not going to mark it. Okay. All right. So the next category is
Swing leg count.
okay. Swing leg count. Perfect. All right. So let me just get rid of this uh, horizontal volume thing. Now the swing leg count, right? Visually, you might say, which swing, Matt? I mean, I see so many swings. Is it this swing? Is it that swing? Right? Well, if we're going to do the daily call for the next day, we want to take into consideration, you know, the swing leg count is most appropriate for what we're dealing with, right? So, right. If we look at what has recently been happening since the beginning of June, which is about a month, the last month has been quite bearish, has it not? I mean, we've had just an intermediate term, even you could even consider this a big picture downtrend because the last month, I wouldn't go 1 to 3 months is big picture, but we'll just say the intermediate term for sure was down because we were going down this whole way. The intermediate term is what's happening the last 2, 3 weeks, but the leg count is how we got there, right? Now, this is pretty extended, but how we got there was one leg, and we went back up. You can say two leg, right? Back up. You can even go 1, 2, 3, 4, and then 5. Okay. In our swing leg count principle, when you get to the fourth or fifth leg count, it's a reversal. So since this was going down, around 4/5 leg counts down, it's now possibly going to get exhausted. And now for that category, it can be sideways up again, or even at the very least sideways, you're like pausing, right? Now, let's go over here, right? Let's go over here for that same category for leg count. When we have this bullish context, it's like, wow, we've been so bullish. What's the leg count? Well, let's see where the trend really started. And this is crazy bullish, right? The trend almost, right? We were in this balance. We'll just say we broke out of here. But I could even go down here, but I'll just say we broke out of here when we did the cross the golden pocket. One, right? One, move down, pull back, two, rest, three. These are huge legs too. It's not just the count, it's also the magnitude of the move of the count. Four, and then five. I mean, so this is also 5, 6 leg counts up, but also extremely overextended because of the magnitude of the move, right? So this leg count category, when we got to here, whether it was here or here or here, it is down. It's a reversal. This leg count now is going to be going down. And look what happened. You know, we've paused. Now, here we have 1, 2, 3, 4, 5 smaller, right? It's not this giant magnitude, right? It's smaller in leg count, but that's okay because every phase of a market has a certain volatility level. The volume was way more back then. It's way less now in the summer. So for our purposes here, right, this would be the leg count now would be, you'd have to be open to this now at the very, so you could go sideways or sideways up would be fine for this. Even up would be whatever. I would not want you to write sideways down or down on a fifth leg count down because that's low odds. Like everybody saw this has been bearish, and now you want to start shorting at the bottom now? No, no. You short when it was scary at the top on five leg counts up. You start buying, at least for this category in isolation, five leg counts down. So, so for this one, right, this one's sideways up.
Sideways up? Okay.
Yep, for leg count. Okay. All righty. Next one.
Dog
Unless you're,
leash.
wait. I'm sorry. Did that make sense?
Yeah, it made absolutely sense. I was just thinking you were going to say sideways or
You know, well,
uncertain.
you know what? Sideways would be fine too. Either one, because it's the idea that I'm open to it pausing now or potentially going up. I'm not open to it going down or even, more because that's the lower odds thing. Could you have 7, 8, 9 leg counts down? Anything's possible. We're always trying to do what's most probable based on what we've seen happen more often than not.
Okay.
That's where these principles come from. The principles come from, will they make you money enough of the time? Not do they have to work out all the time? And the other thing is that's why, like, we're not only looking at leg count to make a decision. We're looking at other things that we're doing. So after leg count, we're gonna go to the next one.
Dog leash.
Okay. So, right, dog leash is basically, you can imagine, right? You have a moving average or something you're using as a central tendency. The image really is that you're the dog walker and you're walking your dog around the moving averages and everything's fine, right? But then when your dog starts walking way too far away from the moving average, it's going to get snapped back because it's going to get too far away and hit by a car. You got to pull it back to save it, kind of a thing. You know what I mean? And if it pulls too hard, you got to pull it back. So the dog leash is like the dog gets pulled back on the leash. The leash is the owner. The owner is near the moving average. So if price, for example, was way up here and the moving averages were way down here, the dog leash would be down, right? And if these moving averages weren't necessarily around where we were now, but were like way up here, then the dog leash would be up because we'd be magnetized to that, like a being pulled from the leash. But because we're sort of around the moving averages, right? We're kind of around the 200. There's not really, you could say, well, we got to get to the 30, we got to get to the 45, but we're around a moving average. I'm not super saying this is up yet. I'm saying this is, when you're around a moving average, you just go sideways. So you would write sideways for this one.
Gotcha.
Okay. And they're going to get a little bit, the simpler ones that are measurable, which I just gave you, like an architect would measure, I just gave you. There's going to be ones that are going to go now from when we get there, a little bit more aesthetic. I mean, you have to have a visual, a little bit of an art. There's a little bit of a science. Some of them are just purely measurable, like we've done. And the final two are going to be actually, you have to pick them because there's no right or wrong answer. It's purely your gut, which is cool because like we all have a gut instinct anyway. So at least this system honors it instead of letting you use your gut to always override it, which in the beginning, your gut will usually always be wrong because this is not an
Okay.
intuitive environment, but counterintuitive.
Okay. Prior momentum.
Okay, so I'm sorry. What's the next one after leg count? We did dog leash, and then after dog leash is
Prior momentum.
prior momentum. Okay, so prior momentum, right, is, for example, let me give you a better example. If you ask me what the prior momentum was on for the next day that we're doing on this day, it would be up because the prior momentum was we went down, but then the buyers snapped it up. And when we create zones, I have this pattern listed as a buying tail. So with implicit in the language itself is what we should do. We should buy, right? It's a buying tail. Now, let's say this buying tail wasn't down, but was like up. That would be a selling tail. Like one example, let me give you a selling tail. That is a selling tail, right? Especially when you see a selling tail at the end of a leg count, that's usually a top signal. See? You know, at least for the next couple of days or weeks here, this was down. Now, we happen to be here, right? And so this day, clearly the next day is up or sideways up for prior momentum, right? Because of the huge liquidation in the buying tail. Now here you have somewhat of a tail, right? Then buyers came up here and they got snapped back down, and then they kind of closed sort of neutral in the middle, not like a crazy, it's just like a little hammer, um, almost like a spinning top doji, right? But not super, but still in the favor of the bulls, but not overwhelming. So the prior momentum in my opinion, based on the fact that we have a selling tail mini and a buying tail mini neutral, so it'd be sideways.
Okay. I
Does that
agree.
make sense? Because it kind of snapped back both ways, nothing crazy.
Yeah, definitely.
Yeah. Okay. Okay. Next one. Does it say MA or something?
Oops. Yeah. MEs.
Okay. So MA stands for moving average, right? And I know for um, the dog leash principle, we use moving averages, but we use those moving averages in a different way. We use those moving averages with the dog leash principle using this, basically using a concept called reversion to the mean, which basically says when we get too far from an outlier, the outliers get too far, they revert back to the central tendency or the mean. Now, in this sense of us using a moving averages, we're purely going to use them as support and resistance. Very simply put, right? Price closed here, but every time we touched the purple moving average, it acted as resistance, acted as resistance. And because we're still underneath it and quite close to it, the moving averages are against the bulls. The bears have control there as resistance. So I would mark that category sideways down or
Okay.
down, but sideways down just because we're sort of at the bottom here. Let's not get crazy. Qualify it. So we're at the
I
bottom of a
skip.
potential range. I'm not saying this is the bottom, right? This thing could just summer doldrum trickle sideways for a bit. So that category, very easy sideways down. Now let's say we weren't below this moving average, but we were, and that actually was something I saw yesterday. It's like, oh, this is going to be a struggle. It's going to be a battle because of that flip on the moving average there. And of course, we have other targets up there that will act as, you know, places where buyers will take profits and so on. But for now, you can see here, this moving average definitely acted as resistance, and we have confirmation from other key reference areas, basically the highs of what would have been today, which was here, yesterday, and the day before. So that category sideways down. Does that one make sense?
Yeah.
All right.
I
And
skipped. I skipped the last one, CCI.
oh, okay. So you want to do the C? We'll do the CCI one next. Is that the next one?
Yeah, I skipped it. I was.
Oh yeah,
Uh,
we went to MAs. That's okay. We'll do the CCI next. Now let me bring up the CCI. Okay. So this indicator here is the CCI, and it stands for commodity channel index, something like this. And I will give you this on your charts. I'll give you all the settings and stuff. And I believe I sent you a CCI document so you can look up the setups. Now what we do for this category, there's nothing in this indicator that you cannot deduce from price action, right? Because all these indicators are derivatives of price, but it's nice to see these things, in my opinion. And some traders claim they can just trade from the CCI. I don't know these, but back on point, right? Now, right? We have here, right? As price was making this intermediate term downtrend and we got the buying tail, right? The CCI crossed this 200, minus 200. Now I have this minus 200 marked with this orange dot here, and I have the positive 200 marked above here. Okay. So when we, and what, just go back. Now, what this indicator is useful for is it can actually lead you to what the market will do next because it's showing overbought and oversold conditions and so on, especially with this setup that I'm going to teach you. It's a very simple one. I think there's 8 in that document, but when it crosses the minus 200 to the downside, that's called a hook from extremes. And it just means that it's going to go up most likely the next day, right? And it did. The next day, it did go up. right? But notice that when it went up, the next pattern here is that, especially if this yellow overshot more, that's a zero line reject. If it doesn't cross this zero line, and then it bounced back down, right? And as it's doing this, it's making these bottoms, but not quite getting as low, right? So what we have playing out here is, at least from a few days ago's perspective, we had a hook from extremes, and it's sort of just mirroring price. So because it's not really telling you anything you don't know here, right? Right? Because this day that we're dealing with is right here. You could mark this category, right? I would be okay with you marking it either uncertain, or you could say, hey, this is a hook from extremes that is playing out. It takes a few days for these things to play out. And I'm anticipating a break from here. So I could possibly mark this as a delayed hook from extremes and at least mark it sideways. But because we are doing this day, right? Not on the day when it actually hit minus 200, there really isn't a textbook setup here other than this thing is kind of playing out. Okay. Kind of like an inverse. And I don't have it with me, and I'm not the best at these, but you'd have to have your sheet to really manifest, basically image this up right. But if there's a call where you're late, just mark it uncertain. So because we're late from the hook from extremes here, uh, you know, we can let this go. Now I can show everyone real quick here. Um, and when I say I'm not the best from this, is that I have these images in my mind, like there's the ghost, there's like ugly Vegas forming, but I still like to go back and compare the images from an actual sheet, because to see CCI patterns and compare them from my mind only to is not as helpful. And I've been doing this for a while, so I would actually open up that sheet, and we'll do that right now, real quick. Where is it? The CCI doc. There we go. And I'm going to share this now. Okay, let me see how I can get that up. There it is. Sorry for the delay. Okay. You can see that zero line reject in that sheet, Matt.
Let me pull it up. Oh yeah, I
Okay.
can see it on your screen. Yeah.
Okay. So this is the one I was showing you, right? When it is hooked from extremes here, right? And there's also this other pattern where it kind of comes up here and forms this, what they call the Vegas. And when it hits this yellow here, that's really the entry. So this is actually, guys, uncertain because it was a delayed hook from extremes, but it's kind of an ugly Vegas in motion here. So you can mark this one sideways at the very least, because it's potentially showing that it's oversold to even sideways up. So I would go with this one sideways. And that's a little bit more of an advanced category, Matt. So we will maybe do a lesson on that where we'll go through those. But basically, those patterns will match up, and you kind of use that CCI index uh, to match it up to find the actual direction for the day. So let me stop this share real quick, and then I will share so this one. So you've been marking these out. So we did the CCI, we did the MA. So the next thing we're gonna do is monthly and weekly, then beauty principle. All right, so let's get that up. I know in the beginning when you're doing these, it'll take a lot longer than we say, hey, you can do this in 10 minutes. It's a snapshot. Once you get good at this, this will take a lot. This will be really quick. It's like second nature, like changing oil or something. So now we're just going to go to the monthly for Bitcoin, right? And it's always good to zoom out. right? So when you look at the monthly candle, right, you're basically doing the same top-down approach as you would on the daily, right? You're looking at different things. So when we came, the different attributes, right? When we came up in here, right, with multiple leg counts up, right? Exhausted, we talk about 5 leg counts up. When we talk about how usually the last candle, if it's the biggest out of them at the end, is usually a sign of exhaustion. Because you want to see strength at the beginning of a move, like maybe down here or here, but not necessarily at the end of a move when we're at resistance, right? And we were at resistance there. So when you're coming up here and it's been very bullish, it's hard to say, hey, now the right thing to do is to be bearish, but it actually is. So what I'd say to myself is that I cannot be bullish now, but I am neutral to now bearish because I'm open. That's where the neutrality comes in. Neutrality means I'm uncertain as to who's in control, but I'm bearish because I know this is a potential spot to reverse, right? And then of course we had the next month, which was a very bearish month, and he pretty much took out the entire data, right? But we had such a strong month from the last time. The most probable thing we were going to do, at least for the next couple months, is consolidate, right? And that's what we did. We built a sideways channel. Now, remember, the last time we came up to this level, it was pretty clear that we had the spinning top and then the engulfing pattern, and it was making that inverse head and shoulders that was very quickly. Here, we're spending time up here sideways, which was bullish, right? And what I'm getting at here now as well is that when we made the breakdown out of the monthly candle, and granted, this chart is way more important at the end of the month than it is in the middle, but we're still going to fill it out, right? When this thing broke down from the balance, which is the last 1, 2, 3, 4, 5 months, and then closed back into the balance, right? You can no longer say, hey, this is a balance breakdown pattern. I'm bearish because this is reversing. We're now making this double top and it's confirming. Once it goes back up there, it's actually a bullish again, right? So you should actually be in this category, at least for the monthly. I'm not saying you have to be sideways up, but you can't be bearish. You could be neutral for this one. You could say sideways. You could say, hey, we close back up in here. I'm neutral, meaning I'm open to this now being a reversal. So sideways would get you in there because it would allow for you to go longs. Sideways up means I'm more bullish than just a sideways, so I can now discount all other possibilities, including shorts, right? And we don't have that confirmation yet, right? So we're not going to go that far with it, but at the same time, right? The fact that we have this quote false breakdown pattern, it's not like this candlestick closed down here and was red, and then right, it was a balanced breakdown pattern. It actually slipped back up into here. That's a false breakdown pattern. That's bullish. So I would mark for this category on the monthly sideways. Because that's really what we've been doing. We've just been going back and forth up here.
Right.
A little bit more complex on that. I think the weekly will be a little bit easier because it's a little bit easier to see what's happening here. Right now, the weekly is a little easier to see, right? That we've had a pause green week, right? And I talked about this yesterday, where you can see here clearly that's that pattern I showed you in that chart, right? We have it touching the 200, and that's when it did it on red. That's when you could actually say, hey, the next week is most likely going to be a green week because we had that quote hook from extremes pattern. We broke down into this blue moving average, which is the 40. We have this launching point of directional conviction candle, and we touched here and touched here, which is actually the top of this giant balance that we broke from. And there's a principle we teach that this was resistance when we came up to it. And when you break resistance and then you come back and test for support again, right? That broken resistance now becomes support. It flips rolls. So very much sideways up for the weekly candle. And not that this is so important for helping me determine the daily call, but I also mentioned that I've noticed that when the blue crosses over the orange here, we tend to have that trend up. And you can just go back and just see it, right? When we were red, we kind of sideways down, 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 and then down here. And then you say, oh, look at that pause. Should I buy there? Now it's easy to see now we should have. But we go back here, right? Orange was over blue, orange was over blue, and that's why it's late, right? Late, late, late. But then it crosses, look, right? Crosses right here, And that's the first sign, hey, this trend is now more than just like a little trader thing. This thing could be the start of a mega trend. And then look, blue, 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 blue. And what's also cool about it is that it's a larger time frame indicator of maybe when you should back down a little bit. Now, when you got here, right, see how people could get out based on price on double tops and exhaustion and other things. So it lags, right? But blue is above orange. But then right around here, orange got a orange got above blue again. And that's when we started to have those problems where we went sideways down, right? And then right here, when blue gets above orange again, it crosses up and then it trends up again. That's what happened here, right? So an interesting chart to look at. So for that category, we'll mark sideways up. Okay, so the next category, Matt, I think is beauty principle, right?
Correct.
Okay. Now, beauty principle is not is something we would look on for the daily. So let me get out of this weekly here. And you can see the daily, right? See, I'll just reshare it just to make sure. Okay. Now the beauty principle is Kobe developed it. It's a way to see how price behaves. It's more abstract than the other ones. It's not as measurable. It's the way price behaves around a moving average or a certain key level or a certain behavioral cyclical thing. So, you might have someone who, an example of it would be, the last time we had a pullback when we trend up, we this distance from price to the moving average is actually going to become more important than actually touching, for example, the moving average. And you can see how when we first came down to touch it, there, you see how it's close enough where it's not necessarily has to touch it. There's this beauty in the distance. So it's a little bit more of an abstract concept. Oftentimes I would, if I didn't see any beauty or I didn't understand it or, I would just mark it uncertain. So um, for this one, I'm not seeing it, how it behaves in a way that any beauty. I see ugliness in this chart. I don't see any beauty. I see ugly. So I'm going to mark uncertain for that one. Okay. Now we're winding up here, Matt. So hopefully you're still with me. And,
Absolutely, brother.
okay, man. And the last two categories, nothing measurable, nothing based on, it's just your gut feel. So the first category, I think, what's it say? Assume being short or something?
Yeah, soon being short.
Assume being short. So assume being short means, hey, imagine you're short. How would you feel? So imagine you shorted this double top or this swing high, and now you see like these buyers bottom building, right? Would you still feel good about your short, right? Would you still want to hold through this in case it breaks? Or if you were nicely in profits and you shorted here and you saw problems here, would you want to take profits and get out and buy back?
Personally, I was probably hold, but I'm a newbie.
Well, I mean, you could hold, right? You could hold in case it breaks. But imagine if you shorted at the top, right? And now you had a move that went from 71 something thousand down to 50 something thousand. And that's a substantial drop. You made like 20%, whatever huge move you made on it, right? And so the question is now, how do you feel? Don't you feel pretty good?
Oh, absolutely.
So then maybe you want to cash in on some of that. So if you're short and you cash in, um, right, you would be buying, right? So if you assume being short,
Okay, all right.
you get what I mean? So I guess the question is that would you still feel good about shorting after we kind of moved all the way down here towards the lower range? But there is no right or wrong category. I kind of feel like I was leading you. So this category actually could be anything. It doesn't really matter. It's up to you. It's just your
So
gut.
What would
So,
you do?
well, how about this? We'll do this. Let's go to assume being long. How would you feel if you, let's just say you hit a double bottom here? Would you well, here's a better way to say it. Do you feel more good about shorting the next day? Like, remember, we're doing the daily call, so we're trying to imagine what the next candlestick is, which already happens, right? But we're just doing an exercise. Would you feel better about shorting the next day, or would you feel better about going long? And if you don't have a feeling about either, then you would just mark it sideways because you're open to both.
It'd be sideways for me.
Okay, so you mark sideways for both of them then.
Okay.
Okay, all
What
right.
would you do in that situation?
I would actually, well, my gut feeling on this is that, right? My gut feeling was that it would be a sideways day, but because we made a double bottom, and this is just, there's hindsight bias because I saw the day. That's why you have to actually really do this before the day starts. And if you want to do it as an exercise, you want to do it on a day you didn't do it. But the idea is that I'm imagining a day that's just going to be sandwiched in between the purple moving average, especially if it's low volume, and this hammer, because it's not like we had a really strong buying tail. We have a super moving average. Intermediate term bias is still down. I'm actually, you know, uh, I would be fine with those two categories, right? But sideways is your gut instinct is fine, right? Makes sense. It's like you're not super excited either way or the other. So I think right now, Matt, we have enough where we've pretty much filled out all categories, right?
Correct.
So the next step is you just kind of tally and see which category, right, has had the highest uh score, and then that's going to be our call.
Pretty much everything's sideways. They
Okay. I
definitely had the most.
didn't really, I could have swore we had a few sideways ups, but I guess do you know what
Oh,
the
we did
actual,
too. Yeah,
well, actually, let's add them up. Like, how many do you have for up? Zero, right?
two.
Oh, you got, oh, really? Oh, let me
We
actually,
had
let's see. Yeah.
SNR support and weekly.
Okay, so let me go to my thing real quick. Okay. Oh yeah, so okay, so on,
Oops, I'm sorry, three. The candlestick pattern, we went sideways two up, you said.
okay, support and resistance, we had sideways up. What did we have for candlestick pattern? Sideways, right?
Yeah, you said sideways to sideways up.
Either one, right?
Correct.
Okay, and then which one did you pick?
I was sideways to up. That's what I
Okay, no,
thought.
I just want to go with exactly what you wrote down, which
Okay.
is fine. And then what did you choose for swing leg count?
We had sideways,
Okay, and then what did you choose for dog leash?
was sideways,
Okay, and then prior momentum.
sideways,
Yep, and then CCI.
sideways to down.
Oh yeah, okay. We had sideways down.
Yeah. Oh,
Uh,
I'm sorry, I switched them.
I thought it was sideways up. No.
CCI was uncertain sideways you went with.
Well, initially, but then remember we looked up that Vegas. There was an ugly looking Vegas, and
Yeah, I thought you
maybe I'm
stuck to
not seeing it
sideways.
100%, but either way,
Okay.
whether we have sideways up or uncertainty, that's what's cool about this system is that even if I'm wrong on this, which is you're going to be wrong, seeing things when mistakes happen, whatever, but since you're only weighting it 1 out of 12 times, you're still going to get the right call, probably. You know what
Okay.
I mean? Okay,
Sure.
so we'll just call that one sideways up, I guess.
Okay.
Okay, moving average.
Was sideways down.
Yep. Monthly,
Sideways.
weekly.
Sideways up.
Okay, beauty principle.
Uncertain.
Okay, assume being short.
I went sideways and sideways.
Perfect. Yeah, you did it. There it is. Bam.
Cool.
Just take a snapshot of it. And it was posted here. Okay, so yeah, excellent. So you say, well, how do we use this information? Okay, well, you know what the daily call is, right? You wrote it down sideways. There's a rule list for all these daily calls. Now, sideways, the rule is we are not trading breakouts or breakdowns. So we're not trading any momentum setups. We are only gonna take setups that are fading double tops for the shorts or fading double bottoms for the long. Now, let's see if that got us an entry, right? Now, remember, notice that when we did our trade plan, we used the higher time frame chart, specifically the daily, to visualize what a day might be and to imagine a scenario. But when we execute, that's when we actually go on these smaller time frames to scan for this rule, which is fade double tops or fade double bottoms. So let's go take a look at a lower time frame and see if there was an entry. Just a quick question, Matt. Are you able to see my screen?
No, I'm still seeing the chart.
You're still see this? Oh, you're seeing this candlestick chart?
Oh, yeah, with the MA monthly, weekly, that's chart.
Okay, let me get out of that. I want to show you my data. That's the daily call. Let me show you my Bitcoin data. Okay, so once we scan for that, we're going to go on these lower time frames, like the 15-minute here, and see if there was an entry. Now, we said the daily call was sideways, right? Now, we made the call around this time and imagine in our mind, right? Let's get rid of these lines here. I don't want to confuse anybody. Okay. This vertical line here that I have, that's the start of the new day around 8 o'clock. Okay. All right. So the rule is we fade double tops or double bottoms. There has to be at least two 15-minute candlestick bars in between, but ideally a wide one would be better. Okay. So now it's aggressive, but this is actually the first low of the day because it moved away. I'm not saying you got to take it, right? But look, right? That's the first low of the day right here. It came down, you didn't get filled here, so don't jump in. But look, you would have gotten filled here had you just followed the rule and put it in, right? That's what the rule says. You fade the low of the day. Now, obviously, you'd want a low of the day that stands out super visual. Like when we're at the low extreme of day here and it's doing that bottoming and you see something like this where it was 3 days ago, it had a huge move up. That's, way better than some little thing in here. But it still worked out because of our daily top down, all the other attributes that we looked at, right? Boom, boom, double bottom got you in. Now, your first place that you'd want to take profits would be at the high of the current day, right? Which is pretty aggressive, but it's at 56.43.5 to 57.287. That's pretty good financing. So you would finance here before it went down, and then you would hold for your real target somewhere up here into the next highs, right? And we got kind of close here, and it's kind of mediocre. So even on a day which is a crappy day, the daily call, which we did live for you, the sideways got us in here. We took off half here when we came back up because that was the first key reference area, the current high of the day. Then the next key reference area is usually the next, the previous high of the day or some top of the range here. That's why I have these two lines. It's like this range, and that range. And these other lines represent other zones and ranges, but I'd have to go through and show you how to do those. But that's how simple it could be. Now, let's just say you didn't take this double bottom because you just wanted a bigger double bottom and you just decided not to. Fine. At the very least, you're not jonesing because, like, let's say, like, I don't know, like you saw this just blast in real time here, and you're like, oh my God, a breakout. I don't know why you think that, but just whatever. So you can't actually just buy because you see a breakout with a sideways call. With an up call, you could, right? But we're sideways. It's non-directional. We think this thing's just going to be a two-sided back and forth mediocre day, which I didn't even trade at all. And I'm totally cool with that. So, that's what the daily call does, man. It kind of can save you. Now, it also can help you time yourself at these bigger major turning points for investors. But, I just decided to do the daily call for today and do it live. So thanks for joining me, Matt.
Hey, thank you. Really
All right.
appreciate it.
We'll talk soon. You have any final questions?
No, it really tied everything together. You
Yeah, I mean,
talked slow, you clearly explained everything. Gave me a better understanding by a long shot.
awesome, man. You got the sheet. there's the weekly coaching call with Kobe, and I'll keep working with you, man. I appreciate your dedication.
Thank you. Have a good day.
Yep, you too, man. Take care.